You know, in the world of investing, there's a lot of information out there. Most investors have a solid grasp on what works. They've heard about the virtues of long-term investing. They get the importance of diversification. And they've probably stumbled upon easy strategies, like index funds. Yet, despite all this knowledge, many investors still find themselves underperforming. Not just a little, but significantly. So, what's really going on here? If the wisdom is accessible and the strategies seem straightforward, why do so many struggle to achieve the returns they're aiming for? The answer isn't a lack of information. It's something much subtler. It's all about our behavior. In investing, knowing what to do is just half the battle. The challenging part? Actually executing those strategies and sticking to them when the going gets tough. Today, I'd like to share why many investors find themselves lagging behind, not through complicated theories or intricate analyses, but through simple, everyday situations we all encounter. Let's dive in with an uncomplicated concept. Imagine our friend Flo. He opens his laptop and checks his investments. He pauses for a moment, pondering. What if I just did nothing? No endless refreshing of the screen. No impulsive reactions or unnecessary tweaks. Just a steady approach, investing routinely and letting time work its magic. Sounds straightforward, doesn't it? But in practice, it often feels wrong. A few days later, Flo is back on his phone. The market has shifted. Not in a huge way, but enough for him to notice. He tilts his head, thinking, should I do something? That tiny moment is where a lot of investors begin drifting off the path. As humans, we're hardwired to take action. When things change, we feel the urge to respond. When uncertainty arises, we crave control. So Flo hesitates, and then clicks. He makes a small adjustment, just to regain that sense of control. But here's the catch. This little action sets off a chain reaction. This phenomenon is known as action bias. And when it comes to investing, it can quietly sabotage your efforts. Before long, Flo is checking his portfolio more frequently. A notification buzzes. A headline flashes. A chart fluctuates. And each time he reacts. A tiny change here, a slight shift there. Nothing overwhelming, right? But those seemingly minor decisions start to accumulate. Unbeknownst to him, Flo has veered off his original strategy. He's now responding to every little movement instead of sticking to his plan. Now let's picture this scenario. Flo and another investor start with identical setups. The same investment. The same market conditions. But their behaviors are drastically different. Flo reacts to changes. The other investor remains committed to the plan. Months roll by and the market starts to climb. But Flo's results aren't matching his expectations. So what went wrong? Let's dig a little deeper. When the market rises, Flo's confidence swells. He leans in and adds more to his investments. But when the market dips, he finds himself hesitating. His posture changes as he pulls back. Not because he's reconsidered his strategy, but because his feelings have shifted. This is the ebb and flow of how money circulates for many investors. Over time, it creates a disconnect. A gap emerges between what the investment actually earns and what the investor experiences. Now, another twist comes into play. The market takes a sharper dive. Flo watches that line drop. He frowns slightly. That discomfort builds up. Losses can feel heavy. He waits, hoping for a turnaround. But that turnaround doesn't come right away. So he decides to step out, just to ensure he's playing it safe. He exhales. Relief washes over him. But then, a few moments later, the market begins to bounce back. Slowly at first, then with acceleration. And Flo finds himself watching from the sidelines, waiting for the perfect moment to jump back in. But that moment never really crystallizes. By the time he decides to act, the recovery has already taken place. Now, let's zoom out for a moment. This isn't just a one-time event. It happens, repeatedly. Small exits, late entries, missed recoveries. Each feels justified in the moment, but together, they quietly chip away at long-term growth. Now, let's touch on something even more subtle: time. Flo gets that investing requires patience. But experiencing time is an entirely different beast. At first, progress feels excruciatingly slow. He checks his portfolio and thinks, not much has changed. Days turn into weeks, and still, not much to report. So naturally, doubt creeps in. And with that doubt comes the temptation to switch things up. Maybe try something new, something exciting? So he makes a small switch. But that little tweak resets the clock on his compounding growth. Every time Flo chooses this path, it interrupts that powerful momentum. There's another trap Flo stumbles into: complexity. His initial strategy is beautifully simple. But as time passes, he begins adding more and more. More charts, more indicators, more inputs. It seems productive. It feels like progress. But with each addition, every decision becomes more cumbersome. There are more variables and more uncertainties weighing down on him. Now he's bombarded with fresh moments of an urge to take action. Fast forward to today's world. Flo's phone buzzes with market updates, breaking news, and fresh predictions. He scrolls through it all, checks again, refreshes the feed. Everything seems instant, yet instead of clarity, there's just noise. Amid the constant clatter, every update offers another temptation to react, even when no action is necessary. At some point, Flo steps back. He closes his laptop and puts his phone down. And he realizes something big. Every time he tried to enhance his results, he ended up making things more complicated. Every time he reacted, he drifted further from consistency. So, he takes a deep breath and simplifies. Back to the basics, a steady strategy. No frantic adjustments. No unnecessary decisions. Just a clear plan that he follows consistently. From that moment, everything starts to feel different. Not exhilarating, not dramatic, just steady. Flo checks his investments less often. He reacts less. Most importantly, he learns to trust the process more. Over time, that steadfast approach begins to shine through. So if there's a key takeaway from all this, it's this. Most investors don't underperform due to a lack of knowledge. They struggle because maintaining consistency is where the challenge really lies. Acting feels natural. Waiting, that feels uncomfortable. And simple approaches can sometimes feel too easy to trust. Flo has shifted his mindset. He's no longer trying to outsmart the market or chase every movement. Instead, he focuses on things he can control. Consistency, patience, his behavior. Because in the grand scheme of things, those factors carry way more weight than any prediction ever could. The market rewards patience, but it tests that patience continuously. And in a world filled with noise, speed, and constant change, sometimes the smartest move is to do less, stay steady, and remain consistent when it matters most. That's the thinking behind Future Flow. A calmer, simpler, and more disciplined way to build wealth over time. Not by trying to do more, but by doing what truly works and keeping at it.